The Fed gave a green light to investors, whether they noticed it, whether they intended or not. You came here for the truth, so let me unveil that for you. There has been this euphoria which has taken over the minds of investors. They got what they wanted to hear. At least they heard what they wanted to. And in this video, I'm going to show you the biggest dump of cash ever. You can believe it right here. I'll show you that first. Take a look. This is incredible. On Friday, the S&P 500 SPY, that ETF, saw the biggest single day inflow on record at $20.8 billion. Incredible, right? Well, look at it. Dating back to the ETF's inception in 1993, this has never been seen. Look at it. Look at that line there. It's extreme. We've never seen that before. And by far, it's not even like close. It's by far. And so we know that more and more and more people are getting this idea that I need to put my money in. At the same time, we are seeing the end of the year, the Santa Claus rally, which has been taking place since October. The market in general has been rising. Yes, there are down days. Yes, that happens. But the general move has been going in. Not surprising. That is the way things go seasonally. We tend to find from, Halloween basically and onward, this rally takes place. And it happens to be with some other events at the same time. Look, that's what's been going on. That's the generalization. But what's happening? Like, what's the nitty gritty of it all? Well, here you can see Meta stock is wrapping up a record year spurred by cost cuts that followed a disastrous 2022. Zuckerberg said we're going to do this thing called the metaverse. People get in the metaverse and they say, hey, where are the people's legs? What's going on here? Nobody wants this metaverse stuff. After a few weeks of realizing it wasn't all that it was claimed to be. But Zuckerberg kept pushing a metaverse, metaverse, metaverse. When they changed their tune and when they started saying AI, AI, it turned around. All they needed to do was, number one, fire a whole bunch of people and then stop talking about metaverse. Stock went up. That's the way these things work, okay? It's not based on reality. It's based on silly things like this. There is no recession risk at all embedded in equity valuations. This is according to Rosenberg, and he's right. It's priced to perfection right now. And you're going to see dips. You're going to see a little bit of, some fear that gets in the market, or in the case of what we saw recently, that happens when positions are put on in order to take advantage of these rises. But in general, if you compare puts to calls, like how many bets are going towards the market going up, how many bets to the market going down, overwhelmingly it's calls. Overwhelmingly. So they're betting that the market will go up. Okay. Looking at it, you'll see the positioning overall. Okay. In terms of PE ratios. Okay, you can look at the US or you can look at the NASDAQ. You can look at, specific markets or specific stocks. But when we zoom out and look at the world index on a PE basis, it's at 17. It's at average, basically, right now at this time. And so overall, like if you want to do that, things are not that hot. But when we start to break it down into certain markets like the United States, then things certainly change. And when we go to tech stocks, it gets even worse. And when we go to certain individual stocks, it goes crazy. This right here, just among other indicators, showing you, are they overdone? Is it underdone right now? And Goldman Sachs, Morgan Stanley, Bank of America, they provide this type of data. Just showing us in terms of the RSI, for instance, yes, going wild and going crazy, too much into one stock all at once, or all in one market all at once. That's what this is showing us. Okay, several ways to look at that. I pulled up like 100 and just giving you a few examples where yes, it is overdone. Yes, it is overbought. But we've seen worse, certainly. And at any moment, there's always some level of steam that needs to come off. So you see a down day here and there, but this is the part of that Santa Claus rally, the seasonality that's generally present unless there's some sort of very big problem. Because and by the way, this is just the calls. So you could see that overwhelmingly the bias is on the upside, okay? All I need to explain is that during these periods of time, the investors, the hedge funds, any sort of mutual funds and things, during this period of time, they have the need, and pension funds, by the way, they have to buy during this time at the end of each quarter, but also big time at the end of the year. And so there's a desire to buy. So that tends to be the bias, and that is one of the reasons why towards the end of the year that there generally is a rally. Like I said, if there was this massive recession and like millions of people were being laid off suddenly tomorrow, that changes things. But just in general, these are generalizations, okay? And look, more of that, you can see European market breadth heads towards resistance levels. And that's generally the way this works, okay? Because you want to see broadly, the broad market doing very well. You don't want to see a handful of names like there is in the US right now today, where breadth is very, very bad. You want to see, oh, okay, a lot of stocks are doing well. It's never 100% of the stocks doing well, but you just want to see that general move. Oh, okay, it's not just one or two stocks carrying everything or just a handful. It's a lot of stocks. That doesn't seem to be the case in many areas. Technical picture is mixed. When we look at the world index, okay, we are getting there. And this is overbought stocks are facing some resistance into year end. And certainly that's where things are. Measuring in the PE ratios, okay, we're looking at it like that. But when we take into account other things, certainly a different story, RSI being one of them. All that does is in a short-term scale, short-term, it tells us overbought or oversold. And these things are constantly fluctuating. And just because it gets to a certain level doesn't mean that things are going to crash. If you study these markets in depth, you start to realize what happens here. As we move up to these overbought levels, which, by the way, in a matter of days, that can flip around and go in completely in the other direction. So don't think it just hits there and stays there. What you got to understand is when we go to these levels, it increases the probability that it turns the other way. That's the same way with price action in a stock, okay? But we look at different oscillators, measurements of whether we go overbought, oversold, how, and that's to different degrees, okay? It's not like a switch, not like a light switch. And so right now, all it's saying is that it is too overbought, and this needs to let off some steam in order for it to be healthy, because the faster up it goes, the harder down the crash occurs. We don't want that. We want nice and slow and steady rise. The Magnificent Seven up for another bull run. What to expect from technology stocks in 2024. You will see this over and over and over and over again. The suggestion that those Magnificent Seven stocks, essentially tech stocks for the most part, will continue to ride it out, especially if they cut interest rates. Why? We have growth stocks. Growth stocks require debt. They borrow. Why do they do this? Because this is the way it works. They're not necessarily producing income. So as a business, if I can borrow at, let's just make up a number, 10%. If I can borrow at 10, but my margin is 30%. or 40%, or whatever the case is, I'm going to make that spread. So it's, I have every incentive to want to borrow, but we have a problem. When this gets condensed, okay, the margins get condensed, we start to encounter an issue that tends to happen when we have higher interest rates. And so that's what you need to pay attention. I'm going to break this down for my Finance Fridays group, but you get the picture. The stock market fear gauge is the lowest level since 2020, and this has changed since then, but the article is all about that. And basically, this is the VIX index, a measurement of stock market volatility. And of course, right now it's getting lower, 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 just like in 2017. Very similar. So we could go into next year potentially with everything being A-okay, right? Or is it a recession and everything will suddenly change? where we are getting some indications that a lot of that froth in the market has been let go, which is a good sign, by the way. Used Rolex prices seem benefiting from rate cuts, sub-dial index. I actually disagree with it. When you look at the index itself, this is the Bloomberg sub-dial watch index, which I'm assuming Bloomberg bought them out recently, because I didn't see that before. It's something I've been tracking a lot. You don't see people like Iman Gaji and all these gurus online that they're talking about their $3 million watch portfolio, yada yada. Well, what were they quoting exactly? Were they using this right now, like the secondary market? Because that is not a legitimate way to price it. But anyway, this has just been coming down. So I don't know why they're saying it's gone up, but here we go. That's a good thing, let me tell you, because when we were going crazy 2 years ago, not healthy, very much, a situation of extreme tight market. The resellers were going crazy. You had your JPEGs doing very well. Suddenly, you remember those NFTs, craziness. But that's the way it is. So you could see the froth, you could see it coming off. I explained everything here in this video and the way that this works. Watch what happens with rate cuts and their relation to tech stocks. Very important stuff. If you want to be at the very forefront of this information, I break that down in my Finance Friday live class. So we call it the Money GPS Finance Live. I do it every Friday. It's a closed group. It is only for those who are part of it. If you want information, right at the top of the link, top link at the, in the description, you're going to get all the information you need to know. There's an apply button. If you apply, that's basically just emailing me. And then, if you're interested in all the terms that are there, let me know. I'll set that up for you. I appreciate you being here. If you want to, continue to see these videos, you got to hit that thumbs up, because that tells the algorithm, hey, show more videos. So I do appreciate that very much. And don't forget to come back tomorrow, and I'll bring you the latest and greatest. Take care.